First guest this hour says that his best idea for the new year is an underweight position in Tesla. He sees delivery and revenue estimates for 2024 and 2025 coming down materially, he says. And it's also a warning of growth, a narrative around the company that he believes could weigh on the multiple. Joining us right now is Bernstein senior research analyst Toni Sacconaghi. We're also going to ask him, of course, about Apple hitting the $3 trillion market cap level again and regulatory and China risk for that company. But let's start with Tesla. You have been negative on Tesla, but now it sounds like you're more negative.
Good morning, Andrew. Look, I think the backdrop is important here, both the market and for Tesla. So the Magnificent Seven have had an incredible year, as everyone knows. And I think there will be scrutiny on these names as we begin next year and people level set and say, where do we go from here? And we think Tesla's earnings are going to be flat next year. We think they're going to have to lower expectations around deliveries for next year. And the stock is trading at nearly 100 times our estimate for next year's earnings. And so if collectively the Magnificent Seven are going to, potentially pull back and investors are going to think about these stocks more critically, certainly Tesla is one of those companies where I do think that we could have underperformance. And as you mentioned, Tesla did very well this year. The stock almost doubled, despite the fact that earnings were essentially cut in half. Analysts thought they'd do about $6 in earnings a year ago. They're going to end up doing under $3. And the stock was remarkably resilient because people believe, that growth is still intact. And I think 24 and 25 are going to be pretty tough years for Tesla. And so you do run the risk of losing this growth narrative. And it's really hard to sustain a multiple like that if people are doubting your growth. So that's essentially the case.
But let's just talk about the growth piece of it, because I understand the margin compression piece of it. But I'm curious sort of what you think about the growth piece of it and the idea, if you believe, and look, it's been a long time, you need the breakthrough to happen. If you believe the sort of self-driving car narrative, if you believe some of the tech narrative, does that change any of these dynamics?
Clearly, if Tesla was able to deliver and regulators were able to accept full self-driving, a year from now, that adds potentially $10,000 plus in profit per car, and that dramatically changes the economics. I think our belief is that it's difficult to know when full self-driving will kick in, but we think it's years and likely multiple years, not only from a technology perspective, but perhaps more importantly, from a regulatory perspective. And then, I think more importantly, we think that over time, full self-driving will become democratized, that there are lots of really big companies investing lots of money in full self-driving. And so Tesla may very well get there first and may be able to command higher prices for a few years. But ultimately, like everything in the auto industry, competition drives down pricing. So that $10,000 per car, if Tesla's able to capture that 3-5 years from now, that could be $1,000 or $2,000 per car 5 years after that.
Right. Let's pivot for a moment to Apple. We talked about it crossing the $3 trillion mark. What do you think the valuation of this company should be 12 months out from now?
Well, I think that's the big controversy around Apple, with bulls saying, look, this is a consumer stock, a great quality compounder. Nike trades historically at 30 to 35 times. Why can't Apple trade at that? It's about 31 times now. The question, I think, always with Apple is, can you buy something else potentially with better growth at a less price? And certainly a lot of investors I talk to say you can buy Microsoft with a better growth profile at a similar price, or Google or Facebook at a better growth profile for a lower price. And I think that's the debate. What's really interesting to me is to look at Apple's largest shareholder, Warren Buffett. And he's typically been a buyer at closer to 20 times. And the few times he sold Apple is closer to 30 or 31 times, which is about where Apple is. So I think Apple's a great quality compounder. But given its valuation level and given that the iPhone 15 is not going to have a great cycle, it's hard to see it materially outperforming over the next year. I think if we saw a pullback in the stock or more broadly among large cap stocks, that would create a better entry point.
Real quick, you want to throw into the mix the risks around China. How should that be calculated in the model, if you will, when you're doing evaluation work on Apple?
Yeah, no, it's a great question, Andrew. And Apple does have outsized risk to China, not only because 20% of its revenues are there, but because 90% of its production and supply chain are there. And that's the existential risk. The talk about, curbs on whether it be government employees or state-owned enterprises owning iPhones, which, was very prevalent in the news a few years ago. We're not really seeing a dramatic change in China. There's always been some issue with both SOEs and government employees in some areas carrying them. We're not seeing that escalating, but there is a broader existential risk that is higher for Apple than it is for other companies if geopolitical tensions increased. And it is something that people factor into valuation.